Hello, welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. Today we want to talk about a very interesting and important topic. The question of whether diversification is actually dead. It's been brought up many times amongst professional investors and even individual investors. Does diversification really matter? And we want to address that and hopefully answer those questions for you today.
And by
So,
the way, I want to mention, at times it comes up even in the academic literature, too.
oh, it comes
Even,
up over and over again
yeah,
all the time. Steve and I are scientists. I'm a PhD in finance. He's a CFA. We are scientists, and we study the journal articles on a regular basis. And we see the information and the studies that have come across. And every time it does point to the fact, I'll just give you the final answer if you don't want to listen to this whole thing. Diversification is clearly not dead. And
yeah.
we can, what we want to do is explain to you why.
And I want to mention, to latch on what Laura said about us being scientists, that we also do a lot of our own analytical work and a lot of our own back testing of various strategies as well.
Yeah, and if I could add to that, that is one of the differences between our firm and a lot of other financial firms that we see is that they don't have the science background and they don't study it, they don't fully understand it, and they don't apply it the way we do. And so we're actually going to be speaking, we've written articles and so forth. We're speaking at another national conference. Everybody knows about the NAPA organization. We're going to be speaking to a lot of the financial advisors there about this topic because it's so important in helping you be successful in your finances. So this chart here is just the past 20 years performance. And we see this analysis over and over again. We could show you in any other 20-year period throughout the past century. But
Laura, I can see you had your colored pencils out. I just want to mention there.
absolutely. So if we look at the first line, domestic large, if you could follow this line here, you can see this is generally the S&P 500. And you can see that over the first 10 years of this decade, didn't do so well. It started doing better. And actually the past 2 years, it was phenomenal. So for all of those people that the S&P 500 is the place to be, they're probably just looking at those 2 years and saying that. They're not necessarily looking at the entire picture. We have 8 different asset classes here. Generally, we use 13 different asset classes, but we felt like these 8 really represented the bulk of what we invest in. We invest in equity for growth. We invest in bonds for stability. And then we invest in market diversifiers to reduce the volatility of the market and to give you a smoother ride. And so, of course, there's a mixture of all that. But we have the equity, domestic large, domestic small, et cetera. And we want to show you portfolios with different mixes of each of these, and they're equally weighted depending upon how many of the different investments are in there. So,
And I want to mention that the numbers that are backing up these graphs came off of a Bloomberg terminal, and they're indices. They're not funds. They're not any managers here. This is reflective of an index returns.
Right, just looking at asset class. Asset class represents different groups of investments that have similar patterns of behavior. So when we look at the S&P 500, which is what they're talking about all the time when you turn on the TV and they're talking about the market, they're talking about the S&P 500, which really is just the top largest stocks that trade in the United States.
Yeah, top 500. Yep.
Top largest. So the large cap stock, I think of S&P 500, large cap, S&P, large cap. They're both the same words. And we can see that the S&P 500, again, this is the line that how it performs. But when we added small...
Can you I want to mention one thing, and just go back to that one slide just for a second, if you could. And, everybody talks about the S&P, and everybody loves to use it as a benchmark and say, gee, how come you're not matching the S&P 500's return? Well, you know something? I would not have wanted to have matched its return from the beginning of this chart up until around 2010 or so, you would have been underwater with just the S&P 500 alone.
And even the first, it's really just the last 2-3 years where it's really kind of broke out.
That's correct.
Yeah. Now, when we added small cap, and again, it's equally weighted, large cap and small cap,
50%
you
each.
see that if you took $100 and you put it in an equally weighted portfolio of small cap, large stock, you would have been much better off than if you just stayed in large cap stock. So even for the younger people, we don't recommend that you just be in large cap stock.
And by the way, once again, though, for the first 8 years, even the small cap would have been underwater, or just about, you would have been broken even just about for the first 8 years, to show you once again that being concentrated in one asset class is not always a winning strategy.
But it took off, and it took off especially right out of the recession, which is an interesting thing to think about when you think about where we are today. Now, when we add international, and international is both large cap and small cap international to our domestic large cap and small cap, you can see also that it's doing better. Most of the years it actually outperformed. It kind of ended the 20-year period around the same place as domestic, but if you needed to take out money anytime in between, you would have been better off having had international exposure.
And you would have been ahead of your initial investment at almost at any point in time in that chart there, by the way.
That's the green line.
Yep.
Now we're going to add a couple of those market diversifiers that we were talking about. So we're going to add real estate, Reits, which is a whole nother conversation on what those Reits are, because it's not just, it's commercial real estate, but it's not just office space and so forth. No. It's very, very diversified itself. And we're going to have a whole video just on that. I think we might have done one. We might do a couple more. But when we add real estate, now we're even performing all along the way even better. I mean, you almost want to ask, why don't you just invest in real estate? And the truth is that we didn't have a crystal ball back in the beginning of 2000 to know that real estate was going to be the top performing asset class. And even if we did, it would not have been a responsible way of investing.
And look, the issue is always is we know what the past 20 years look like. Do we know what the next 10 or 20 will look like? And we just don't know. Right. No one really knows. And I think if you'd ask somebody in 2000, do you think that the S&P would underperform most asset classes for the next 10 years? I don't think anybody would have thought that. I think a lot of people thought possibly the S&P's return would be lower because of the valuations we saw in 1999 or 2000, but not for 10 years necessarily.
And actually, the best performing asset class out of all of these was the international small cap, right? Yep. That was very volatile. But if you had put all of your money in international small cap, you would have wound up with 9 times your investment over the past 20 years, which is quite a return. Yep. But we would never recommend you doing that because of the volatility. No. Now, so we have a portfolio now with domestic investments, global investments, real estate. What about if we add in convertible bonds, another favorite asset class of ours that we've been using for quite some time? And you can see that even with convertible bonds, we're now getting even a more, so that blue line is all the prior investments that we just mentioned, plus adding in that new asset class, convertible bonds.
Yep.
When we add natural resources, which is the orange line, it does bring the number down a little. Natural resources has not been doing as well over the past even decade or so. Although you can see that it helps the portfolio in the beginning, the first 10 years, not so much recently.
And I want to mention that it's beginning to catch up again because of various things that are happening in the economy right now. We see oil prices increasing and some other commodities going up in value. Suddenly, natural resources are recovering. We've seen the 5-year annualized return start to increase dramatically of late.
Yeah, if we actually added the past couple of months in 2021 to this, I think this chart would even start showing that.
Yeah.
And then, of course, bonds, which are a stabilizer, and most people should have some bonds in there. They represent a reservoir of money that you have access to regardless of what happens in the marketplace. And they do also offer some stability in your portfolio. And it does bring the portfolio down a bit, although it still outperforms the S&P 500. It still outperforms large cap stocks.
Pretty stunning when you think about it.
It really is. And then lastly, we still see that there are people that call themselves professionals in some of the top investment houses that insist on
Which you won't mention.
right. They insist on doing.
By the way, we see with advisors as well. You know, I want to mention that too.
Yeah, they still stick to this concept of a 60-40. Now, what is a 60-40? A 60-40 is basically 60% US large cap stocks and 40% US bonds. And they insist that they don't need to do this diversification. They just invest in those two items. And so when I add a 60-40 portfolio, which is the pink line, you can see that you were able to perform as well in terms of your ending value as the S&P 500, but not as well if you had included those other diversifiers. And you know, the thing with 60-40, what we've seen in the analysis is that in any period of time, the 60-40 or the S&P 500 can outperform for a period of 5 years, maybe even 10 years. They could outperform a very diversified portfolio. But when it comes to a 20-year period, not so. In a 20-year period, these additional market diversifiers really add to your portfolio.
And I want to mention here that this is I would call it a naive allocation from the aspect that we also call it a 1/n. And what that means is you take the number of asset classes and divide it equally among them. And if you use a much more sophisticated approach like we do using modern portfolio theory, we don't necessarily divide the portfolio evenly among the asset classes because we look at the mathematics behind it and we look at the interaction among the asset classes. And we use a much more sophisticated approach to decide how much should be in each of the different assets.
We're managing to risk, right? So,
yep.
So there's different people that are able to tolerate different levels of risk. And we need to make sure that we're taking on enough risk to give our clients the right, a good amount of return ahead of inflation, ahead of taxes, and can grow your portfolio without subjecting you to risks that might compel you to do the wrong thing, like cash out at the wrong time.
And it's also a matter of managing to having the most efficient portfolio. So in other words, what that means, and it's a ratio, which is called the Sharpe ratio, is having the most unit of return per unit of risk. And so if you're taking less risk, and you can accept lower return for that reason because you still have a pretty efficient portfolio using that ratio. And so we try to maximize those ratios across the spectrum of risk versus return.
Yes. There's a lot of statistics behind the analysis that we do to create these portfolios. And for anybody that's interested in learning more about them, maybe we'll do a video that people can watch if they want to, that actually gets into more detail like that. But as you can see, a diversified portfolio is going to get you the most amount of money in the long run, maybe not any little snippet of time. You have to let this work over the long run. And we highly recommend that you always stay in this type of portfolio. Again, if you have any questions in particular around your portfolio and the level of risk that you're taking, we're always available to talk about your portfolio and the overall recipe or the asset mix in your portfolio, how it's performs over this period of time, and why we think it's the best portfolio for you. So thank you again for listening to us, and I'm sure we will see you again soon.